Welcome to our educational video about value investing. Value investing refers to purchasing company shares that are undervalued in the market. People who are involved in value investing buy securities for less than their intrinsic value. Successful investors such as Warren Buffett and Peter Lynch are proponents of this type of investing. Have you ever found a hidden gem at a flea market or scored an amazing deal online? Value investing is a bit like that, but instead of hunting for rare antiques or discontinued electronics, we are looking for undervalued companies and buying their shares in the stock market. The core behind value investing is buying something for less than it is worth. The value investor focuses on purchasing company shares. They are specifically interested in shares that are worth more than their current stock price. The concept of value investing is not new. It traces back to the 1930s and the teachings of Benjamin Graham and David Dodd. They believed that a stock's price doesn't always reflect its true worth. Their approach was simple: buy good companies at a discount. This strategy has become a cornerstone of successful investing. The process of value investing can be broken down into 3 key steps. Let's take a look at them. First, investors sort stocks by metrics like the price-to-earnings ratio to identify potentially undervalued stocks. By doing this, they can reduce the number of prospects to a manageable list. Otherwise, it would be far too big. In step 2, investors sift through these stocks to determine which ones are truly undervalued, separating the good from the bad. They analyze the company's financial statements, market positions, and future growth potential. This helps them differentiate between temporarily undervalued stocks and those that are fundamentally strong but have been overlooked by the market. Finally, they compare the intrinsic value of the stocks to their market price to decide whether they are worth buying. A stock whose current price is at least 33% lower than it is actually worth is truly undervalued and should be included for consideration. This margin of safety ensures that investors minimize risk while positioning themselves for potential high returns. Value investing contrasts sharply with growth investing. While value investors seek stocks that are undervalued, growth investors focus on companies that show potential for substantial future growth, often paying high prices for them. The difference lies in the approach and the type of risks each investor is willing to take. Despite its successes, value investing faces criticisms, primarily regarding the difficulty of accurately determining a stock's intrinsic value. Critics argue that since calculating intrinsic value involves some subjectivity, different investors might arrive at different values for the same stock. This makes value investing as much an art as it is a science. One of the world's most famous value investors is Warren Buffett, who in 2024 has a net worth of $134 billion. He has built a fortune by buying great companies at reasonable prices. Think of it like buying a high-quality car at a used car price. You get all the benefits, but at a lower cost. Buffett's successes demonstrates that value investing isn't just a theory, it's a proven strategy. In conclusion, value investing is a time-tested strategy that focuses on finding undervalued securities with strong fundamentals. It requires patience, thorough analysis, and a willingness to diverge from popular market trends. Since the 1930s, value investing has helped many individuals amass significant wealth, turning some into millionaires and even billionaires. Thank you for watching this video. We hope you found it interesting and useful.